So I know November hasn't been great in the markets, and I figured I'd do a quick video on how I stay rational when everything is seemingly selling off day after day. Because as a new investor or even someone with more experience, the fear that creeps in when the market starts to drop is mostly stemming from the feeling of uncertainty. You don't know how far down the market will sell off, or when you should be investing more money while everything is at a better discount. But if you can get an idea of how the market will move, and where there might be potential buying opportunities, it helps to alleviate those emotions you might be feeling. Before we get into the video, if you enjoy this type of content and want to follow for more, feel free to like and subscribe for future videos. Now let's get into how it all works. So I'll try to keep this as simple as possible, and if you're interested in further details, I'm sure you can find other videos on YouTube about these topics. For this video, we're looking at the S&P 500 futures chart, and I'm using the 1-day chart here, so each candle represents one trading day. There are three main indicators I tend to look at for analyzing the charts, and these are the 60 SMA or simple moving average, fair value gaps, and support and resistance. Starting with the 60 SMA or simple moving average, it is an indicator where it calculates the average price over the previous 60-day time period. So this will give you a clearer picture of the overall trend and smooths out the price movement over time. On the charts, if the price is above this line, it means the market is bullish and it acts as support areas where it might reverse. On the other hand, if it starts to trade below this line, it means the market may start to trend bearish, and the line could act as resistance areas where it could push the market further down. Next, we have fair value gaps, where these represent price action and indicates an inefficiency that is caused by the price moving up or down too quickly, which ends up leaving market participants or orders unfilled. So this is liquidity that can be potentially filled in the future in order for the price to continue further up or down. To identify these gaps, these are indicated by a 3-candle formation or sequence. The first candle isn't all that important, but it's the first one in the sequence. The second candle is always going to be an expansion candle, which is where the fair value gap is created. Then the third candle is the final one, where the price doesn't go back down to fill in the gap being created by the second candle. This then completes the 3-candle sequence, and is where we can then draw our fair value gaps. When drawing the fair value gaps, they'll begin from the top wick of the first candle, and then to the bottom wick of the third candle. It might take a little bit of time to spot these at first, but the more time you spend in the charts will eventually help you quickly see them. So what happens in these fair value gaps is that you can see these as potential areas where the market can eventually trade back into or fill, so they can provide fair value before continuing in a specific direction. On the chart here, I've only drawn some of the most recent fair value gaps, so you can visually see it in action. The green rectangles are bullish fair value gaps, and the red rectangles are bearish fair value gaps. So on the most recent day which I'm recording this, which is after the market closed on November 20th, we see that the S&P 500 traded up and approached a bearish fair value gap, and then see it heavily sell off to where it is now at the blue line. As you can see, it doesn't strictly have to trade into the rectangle all the time, but because this gap didn't get filled and we traded away from it, we can potentially expect the market to eventually come back up here to fill it in at some point in the future. Again, not all gaps will get filled, but they're there to give you contextual information as to potentially where the market could go to in the future. Then lastly, we have support and resistance. This one is a bit more subjective, but in general, you would look at the chart and see which areas the price has traded back into and reversed. There are no real rules, but in general, the more times the support and resistance level is hit and then reverses, the stronger it is. On the chart here, I've kept it simple and only indicated one support and resistance level with a blue line, but there are many other blue lines you could draw as well for potential support and resistance. Also, I just like to point out that this is really more of an area even though I drew it as a line on the chart. So the price might go slightly above or below the line before potentially reversing. Another thing to mention is that support can be future resistance, and resistance can be future support. On the chart here, you can see at the beginning, the blue line was actually a resistance level and was hit 3 times before it finally broke. Then afterwards, it becomes a support level, where it was hit once, twice, and then right now being tested for a 3rd time. Now that you have an idea of what all the indicators are, I'm just here to caution that these are not bulletproof and should not be treated as guarantees. The whole purpose is to help provide context for you to understand potential market movements and where the market could trade into when there are sell-offs or pullbacks. By knowing where the support and resistance areas are, it removes the emotional aspect and rationalizes the market volatility. In general, market pullbacks are healthy and will happen at least once or a couple times every year. So when they happen, instead of being uncertain and fearful of a bear market, knowing through technical analysis where the market could pull back to can give you the confidence to stay invested. As I like to say when showing this to people, this can show you potentially where the market may move to, but you won't know how or when it will get there. So given all the information now, what is the chart telling me right now where we're at today? First, the sell-off was a possibility because it was approaching a bearish fair value gap. Second, it looks like it's starting to close below the 60 SMA line, which means bearish sentiment might be happening. Thirdly, the market closed at the bottom, where the blue support line is currently at. And fourth, the market in after hours right now is showing some small signs of support and recovery, indicated by the latest green candle. So if this blue support area fails to hold, we could potentially see the market go down further, and trade back into the levels we saw back in July and August, where there are multiple fair value gaps for support. This may or may not happen, because lots of other external factors can also dictate where and how the market may move. Some good news can come out and save the markets, or some bad news can happen and put us into a bear market. You never know what can happen, but through this, at least you can be more contextually aware and hopefully make more rational decisions. That's it for this video. Consider supporting the channel and subscribing for future videos. And with that, I'll see you in the next video.